Let's talk about the medevac helicopter. Y'all invested 13 million in a medevac helicopter business that had 4 million in EBITDA. The investment was double what the EBITDA was. Was that like a 90% of the company, 80% of the company? What does that look like?
So this was like atypical. So the typical deals we do are sponsored. And so these are going to be 4 times levered or less, where we're doing half this capital stack, right? So we'll do the debt in case it's a $40 million deal. We'll do, $20 million of debt. They'll do the equity. In this type of deal, this is a non-sponsored deal. We did it directly with the owner.
Sponsor meaning there's a private equity firm, right?
Sure.
That's leading it. Yeah.
Yeah. So in this company is very interesting. So we gave them a direct loan. It was a pretty good deal at the time. It was like, so this is a 3 turns of leverage is what we got in at. We didn't have any equity when we started this transaction, and the company actually quickly hiccuped. And because I said earlier, patient capital, we were able to provide rescue capital and expertise, heavy expertise. And that's been the same case throughout the life of this loan. But in return for our rescue capital and our kind of sweat equity, we received 22% of the business. So that $4 million EBITDA company today has a run rate of around $40 million of EBITDA.
Oh, wow.
So that's a company that we would expect to have a sale. And we have $2 billion in assets. We got $1.3 billion in market cap. We'll have a $2 million equity position. Actually, we put additional equity over time, but we have $2 million in equity and warrants. We could see, I prefer not to say anything because it's in the market. Yeah, right. But that can be
It's a multiple.
Yeah. Yes.
Right.
What is rescue capital? Because that sounds like something I would love to have.
Yeah. Well, rescue capital is when you're basically, in this case, it's a lender of last resort. But because we were already in the deal, these are the ones where their preference, where we have a good sense of who they are. We understand the business model because we just did our diligence on it, which for us is extremely exhaustive. In the lower middle market, different than others, there's no waiving in of deals. You go through a really 4 to 6 month process between when you find a deal, you screen it to see whether it makes any sense. You go through a 2-month diligence process. You meet the management team, you talk to industry experts, and you go on another month of diligence, answering questions before you close. So in this case, we had gone through all that process, and we knew that this was a valued business. It just oftentimes in the lower middle market, the business expertise is not all there, and so they need help. And oftentimes that's why they're seeking this capital out there. There's a recognition. So in this case, we felt pretty good. In order to create the success, they needed the capital. And those are the situations where we love. When all you have to do is put capital in to help stem a payroll situation, right? The rescue capital is when they can't make payroll. And I remember, 5 months or 5 years ago when they came to us, it was, we can't make payroll this week. And so we sat down, we created, a revolving line of credit structure for them to lend to them, to help give them, they had to build out a plan, a 13-week plan and a strategy, and they had to hit their marks to be able to draw on the credit facility. But assuming, they did hit all their marks, they borrowed our capital, and then they started growing. And then this is the kind of company that, because it's medevacs, they build out bases all over the country. And so it requires cap-ups up front. They have to buy, or lease jets. They have to actually build out bases at hospitals. And so it requires a lot of capital out front. So it's the kind of thing that doesn't create a lot of cash flow until it does. And so right now, all of the different bases are creating significant amount of cash flow, and yet they're still building out. So it's not as much cash flow as you'd expect, but it's got a huge white space. So as soon as you stop spending money, that's going to see the working capital unwind.
So they wouldn't lead with rescue capital, right? They already have a position.
I got excited.
Yeah.
There are distressed investors out there. That's not the role they play in the market, unless in a rare situation like this, something gets a little underwater.
Yeah, there would have to be something. I can't recall a single time in the last decade where we actually made a distressed investment. But certainly we support we had a handful, as every portfolio does, of companies that require capital and, hopefully good money after the good money.
So you're publicly traded. So you raise capital in the public markets. You use that capital. You had capital in the business when you took it over. Do you then arbitrage capital? You go borrow money and then make your investments? And
yes. Okay. So we do it over various forms. So, we started with a $100 million credit facility. Eventually, some of the other instruments that BDCs have access, right? One's called a baby bond, which is just a $25 par. It's kind of a retail instrument that you could raise somewhere between 50 and $100 million. Typically, it's costly. Like the first deal we did was 6%, which actually, today that's not so bad.
Right.
Back when that seemed like it was pretty expensive.
Yeah.
We have SBIC capital. So we have through the SBA program, the Small Business Administration. If you're lending to companies that are typically between $3 and $10 million, which happens to be right down the fairway for us, they'll lend you, if you apply and get a license, you get a kind of a proctology exam by the government to get vetted as both of that, your backgrounds are safe, but also that you're successful investors. So we've had two licenses to this point for $350 million that we invest, and it's very cheap money. And it's very long dated money. So then we've also hit the institutional bond market. We have two credit facilities. So that first credit facility we started at 100 is now over $500 million with 12 different banks. And then we have a large credit facility with Deutsche Bank. This becomes a lot easier, and I hate to even say that on film, but you had to build out the business, and then so the debt size becomes a lot easier. We've been very successful. We are very conservative, Ben. I mean, our assets are only levered 3.4 times.
Okay.
So our debt to EBITDA for our businesses, and our balance sheet's levered less than 1 times. And so that's, fairly conservative, certainly relative to banks that are 10 plus times leverage. So that helps draw in bank lenders, as well as institutional investors to want to lend money to us. Anyway, on the equity side, we used, we had their secondary offerings, but we use what they call an at the market or ATM program, where we raise equity through underwriters on a daily basis, just on a one-off basis. And we're able to raise, $40 to $60 million a quarter. And we use that to sort of balance leverage and liquidity. So it's very effective. It's the most effective way to do it for our shareholders, because a lot of others will go in the market and raise $100 to $200 million of equity, and they hold it on their balance sheet. They pay down their credit facility, and it's stagnant.
Right.
For us, we just raise the money as we need it and invest it right into our loans.
Yeah.
The loans that you're doing, are they more short-term, mid-term, long-term? Like what, is it, no two cats the same type thing?
No, they're almost all. So first of all, 90% of our balance sheet is first lien assets, and it's the unitranche, what I described earlier. They're all pretty much 5-year maturity. There's occasion right now. It's kind of, I don't know if you've seen it, 7 years become in vogue. Now the interesting part about it is 75% of our loans are to companies that do extremely well, and they'll refinance us out, or the company gets sold within 3 years. So, and kind of hate that, right? Because you got to continue to rebuild. There's probably another 20% of them that are the C plus, B minus students that we love. They'll stay in for the full 5 years, and they may actually tack on a few extra years. That's great for a dividend paying stock. And then you've got your bottom 10% that never leave you, that you're trying to nurse to health.
So you have an equity component. It's a small piece. Well, I say it's a small piece. What percent of your portfolio is in equity?
So we've targeted 10% of the total balance sheet in equity.
Yeah.
So we've done, from a cost basis, we've actually only done 6, but for a fair value basis, it's about a little north of 10.
Yeah.
Because we've had a lot of success. And kind of noting earlier, we have one large investment. We've actually sold 3 companies in the last 2 quarters for total gains of $44 million.
Wow.
So very successful when you look at the size of our balance sheet. It is hard for us to actually continue to maintain 10% on the equity side, because our balance sheet's grown. We're able to continually increase the size of our debt check, but the sponsors are pretty tight on equity. You have to beg to get $500,000, $1 million. And so the area that we're trying to break into is really on the non-sponsored side, where that's more of like a $10 million debt check and a $5 million equity check, and you're sort of the majority owner of the equity. We weren't big enough the last 10 years ago to take on that risk. We needed more debt to grow our dividend. Today, we've grown to scale, and so we feel like we have the ability to write those larger equity checks. But that's something we're looking to build out right now, working with family offices, just trying to hire a BD person who kind of works in the market, can find those investments